You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it's time for Options Playbook Radio, the program here on the Options Insider Radio Network, where we break down all of those amazing options plays, offensive and defensive plays, and tell you how you can incorporate them into your own portfolio. If you're saying to yourself, hey, wait a minute, he's not the usual host of that program, you're right. My name is Mark Longo. I host a lot of shows around here, but usually not this one. Usually it's another guy who I'll get to in a second. But of course, the reason I'm subbing in today is because it is such a special episode. It is our 100th episode spectacular. So spectacular indeed that we had to break it up into multiple episodes. This is part 2 of our 100th episode spectacular. And joining me, as always, for this spectacular of options fun is your regular host, the options guy over there at Trade King, Mr. Brian Overby. Brian, welcome back to your own program and happy 100th episode to you, sir.
Well, thank you so much, Mark. I really appreciate you hosting this event and the fact that we've got to 100 episodes and that it's been so well received by the listeners over at Options Insider Radio that I wanted to go on out and talk about some of the paper trades that we've looked at on Options Playbook Radio. And I really don't think it's enough to just say that whenever I look at a trade that there's only one opinion in my way or the highway. So I thought it'd be fun to bring in some experts that are also in the industry, some good friends of mine that are sometimes on Options Insider Radio, sometimes on the Trade King platform, and ask their opinion of specific episodes that we've gone through and that we've looked at. And we recently did a trade in Twitter on iron condors. Now, iron condors in the options playbook is page 126. And I decided to ask a good friend of mine, Dan Sheridan from Sheridan Options Mentoring, to look at this trade with me. And I'm going to introduce him here in just a second. But if there's a man that knows iron condors, I know that man is named Dan Sheridan. I've heard him teach iron condors left, right, and sideways. So with that being said, I'm going to jump right into the trade. And then I want to ask Dan a few questions and look at his opinion on the trade. Now, all of these trades were done basically around earnings, which, makes it kind of tricky, but it also makes it interesting because after the earnings event, something happens. And that's usually the case when you're looking at different stocks. So this stock was Twitter. Most people know it out there. Symbol was TWTR. And we actually looked at this trade right before the earnings announcement. So we looked at it on a Wednesday when it got taped. And it was kind of interesting because Options Playbook Radio wasn't published until the following day. So the earning announcement had already happened and the trade was already rocking and rolling. So an iron condor, as I said, is on page 126 of the Options Playbook. So I'm assuming that you kind of understand that if you're listening to the call right now. And I'm going to give you the strikes. We'll start from the highest strike down to the lowest strike, and we'll look at the risk and the potential reward of the trade. So the highest strike call that we bought on the call side is we bought the 21 strike call that went out and had expired on February 19th. Okay, that's the call that we looked at. Now, this trade was being put together on the 10th of February. That's meant that this was a 9-day option contracts, and they all had the same expiration, which is common with an iron condor. So the first call we bought was the 21 strike call. We then sold the 19 strike call. Then we went down to the put side and we sold the 11 strike put, and then our hedge was to buy the 9 strike put. Now, Twitter at that point in time was trading at $15.58. So we were right at the money, basically, or almost right at the 15 strike line. We looked at the long straddle, and that was mentioned in the call. And the long straddle at the midpoint was trading for 3 points. We had an implied volatility of 172% on that front month option. That's where that implied volatility was at. So it was a really crazy time for Twitter. And these were the strikes that we were looking at. Now I'm going to make a couple other points though before we get too far along, but the whole trade was done for, at the midpoint, a net credit of 41 cents. And on a 2.1 wide spread, that meant that there was $1.59 of risk. And that risk was going to be intimate because they were announcing earnings. Right after that trade, after we looked at those trades and looked at those pricing, earnings actually came out on Twitter. Now, part of my thought was Twitter's been beaten up. I mean, the high at one point in time, I'd say within the last year, was well over 50. And now it's already down to 15. It got beat up a little bit more. The stock was very volatile overall. And I was kind of guessing that maybe this was a little bit overdone. And to look at that long straddle. Now, remember, we used the 19th expiration that went out 10 days. They had a different expiration that expired in 2 days. That implied volatility on that expiration was around 313%, rounding off in that scenario. So with all that being said, my thought just in general was that the vol was a little bit juiced, to say the least. And I actually even got quoted in the Wall Street Journal that week about talking about, one of the largest expected moves that Twitter has ever seen on a percentage basis. I mean, 3 points was about 25% of the underlying is what the underlying stock was looking to move. Okay, so went out 10 days, and I'll talk a little bit about that, but I kind of want to get Dan's idea on this little trade, on this little thing, and scenario that came up, and ask, would you ever do a trade like this around earnings? Do you like iron condors? And if you don't, be candid about it. Let us know. So I'd like to introduce now Dan Sheridan from Sheridan Options Mentoring. Hello, Dan.
Oh, hi, Brian. Thanks, Mark, and thanks, Brian, for having me. And I think this is an interesting trade in Twitter. First thing I could, talking about this trade, I don't have a problem with the trade. I don't have a problem. I think the thinking was right on. There's not a lot to disagree with, as far as why you put this trade on. I think the big thing, in my opinion, for viewers would be, the first thing is they hear this iron condor, right? They hear this term iron condor. And I want to be clear that this to me is a spec trade. I normally would do an iron condor in SPX or RUD or a stock when it doesn't have earnings or something. And I'm putting it on every month, 4 monthly income. Here, it's like I grew up on the west side of Chicago. On the west side of Chicago, they sell baseball bats. And so when you think of iron condors, you think of this range bound, nice, warm, cozy strategy. And to me, we're using a baseball bat to beat somebody here, in my opinion. We're using an iron condor in a totally spec situation, right? So it's a much different, it's like a totally different strategy to me because you can't adjust it. You know what I mean? I mean, once Brian puts this trade on, I'm assuming if I lose, I could lose I could lose my margin of $159, right? So when I do this trade, when I do a normal SPX iron condor every month, if it goes against me, I can adjust it. It's the stock or the SPX goes up, goes down, I can adjust it. Here, once Twitter closes, what did earnings come out on a Wednesday, Brian?
Yes, right after we taped this event, the earnings actually came out.
All right, so if I put an iron condor on Wednesday, the last chance to put it on would have been Wednesday towards the close of trading. I can't trade this sucker until Thursday morning when it opens. And it could open $5 higher, $5 lower, whatever. I can't adjust it till it opens. So the way I look at these trades is if I'm willing to risk let's say I'm willing to risk $1,000 on this type of a spec trade, that would determine my size. So my margin's $159, right? So I'd take 1,000 into $159. And what's that, about 6 contracts, somewhere around there? So I would do 6 contracts here. But in terms of and that's how I would look at it. I would look at it that if I lose, I'm taking the stance that I could lose everything, and that's going to control my size. Totally different considerations if I'm doing a normal, let's say, April SPX iron condor right now, right? Totally different way of looking at it. But in terms of the trade itself, all the thinking is exactly how I look at it. Speculative earnings plays. And again, I look at it, I think it's important, Brian, pointing out, you didn't come into this thinking you're going to do an iron condor. People think, okay, I'm going to do an iron condor. No, I do iron condors and earnings type stocks like Apple. Apple's a good stock that usually the market maker move that you talk about, usually it moves less than the market maker move. And an iron condor would be a correct strategy in those situations. But I think your analysis was, hey, this is the expected move. You were counting on it moving maybe less than the expected move. So then after you did your homework, then you decided an iron condor was something that could, fit your opinion. But you didn't come into here thinking, I'm doing an iron condor, right?
You're reading my mind exactly, Dan. I really did not look at that. I was looking for volatility. I was actually thinking about back spreads, thinking about something else. And there was a lot that came on with that stock that week. So I find it interesting that you're saying that, because that was actually the stock that we talked about in our midday market call at Tuesday on the Trade King site. So yeah, I really wasn't thinking that going into Twitter. So yeah, right. Keep going. I'm liking what I'm hearing.
Yeah, I mean, the only thing I don't, here's the only thing, just so Brian and I, you can't say that we're like, we'll never disagree. The only thing that I look at here, a lot of people do iron condors for earnings for the wrong reasons, right? In other words, they'll say the volatility's high, so I'm going to sell this high volatility. The volatility will come down, and that's how I'll make my money. I think that's wrong thinking. Of course, the volatility's high, every earnings period, right? For a lot of these stocks, not all of them. And so to me, I wouldn't do an iron condor. Number one reason, because the volatility is high in Twitter. I'm doing an iron condor because I think that the Twitter move is going to move less than the market maker move, or less than the expectations. And therefore, an iron condor fits my opinion, right? I'm not just selling it because the volatility is high. The volatility is going to come down. There's no doubt. But the stock could be up $7 and then I get $7 or $8. So I'm only selling an iron condor. Sure. I guess secondary, the volatility is high, and that's a reason. But the reason I'm doing an iron condor is because I think the actual move is going to be less than expectations. It could be high volatility. If I think the move is going to be more than the market maker move, I could do the unthinkable, right? I could buy a long straddle, buy one at the money, call and put. So I think the strategy is kind of driven by only at the last point when, hey, it comes down to, do I think the move is going to beat expectations or not, right? And I think some people say, they get caught up in, I'm selling it because the volatility is high. That's not the main reason I'm doing it, right? I'm not, the reason the volatility is high is because there's an event called earnings, and the stock has a history of moving plus 10%, more than 10% every earnings. That's why the vols are high. And so anyways, I just think it's, that was more just for the public listening, how you should approach these earnings type situations. But I think for people looking, I think Apple's a good one. Apple, if you look at the last, Brian, I don't know if it's the last 12 quarters or 13, if you would have done a 10 delta iron condor on the weekly, you'd make money at like 12 quarters in a row because it's... All
right. I heard some Dan Sheridan mentoring lingo there. What do you mean by a 10 delta?
Oh, yeah. So a 10 delta would be, so if you look at Apple the day before, or Twitter, like Brian did here the day before earnings, I'm looking to pick my short strikes of the iron condor by the delta. So if I sell a 10 delta in the call and in the put, that means there's only a 10% probability we're going to finish beyond that strike by the expiration. And if it's a weekly, that's just a few days. So basically, if you're selling a 10 delta call and put, it's got about an 80% probability of expiring worthless. So again, 10 delta means there's only a 10% probability we're going to finish beyond that strike. So a 10 delta iron condor, I've classified it years ago as called a high probability iron condor. So I'm selling a 10 delta call, 10 delta put, and it means the probability of all the options expiring worthless are about 80%. And so that type of an iron condor works well in Apple. And I don't know the deltas that Brian picked for the 19 strike in the calls, 11 strike in the puts, but my guess is with the stock at 16, it was pretty close to a 10 delta would be my guess.
All right, Dan, that awesome explanation. Thanks for taking the time to say exactly what that meant. Now, yeah, they were. They had to be, especially what really amazed me about this trade was that we got it done for a 41-cent credit to be that far out. But then again, I told you the implied volatilities were 313% in the very front month and 172% in the expiration that we were trading. And I just was amazed that we could get that much credit on a 2-point wide spread. The risk reward was fairly decent for what that trade was, basically that to be able to get 41 cents with $1.59 worth of risk. And we went out one more expiration. And part of the reason why the thinking there was that I wanted to be able to close that position. If it started to go against me, I was hoping the juice might stay a little bit in it and just be able to get out. But I would have never let this thing, if it gapped open below the short put or the short call, there's not much you could do. But I would have been prepared to trade out of this paper trade. I would have been prepared to trade out of it if it got anywhere close to those strikes anywhere before expiration. And the strikes were 19 and 11. And remember, the stock was trading right at 15.
Hey, Brian, 2 questions. What did you look at what this iron condor was trading in the weekly?
No, I didn't. Actually,
okay.
I didn't.
My bet is it was pretty close to 41.
I have a time and sale. There were only 2 days remaining to expiration. I probably did, but the one thing is to think about, and I just got done talking about this with Andrew from Options Pit, is to think about gamma in this scenario. If you're selling something like this and it's this close to expiration and it's right around earnings, you got a ton of gamma that could hit you if it did gap open. There really just wouldn't be much you could do at all. if you give yourself a week in a very volatile stock like this, you usually got an option. You got something that you might do. And I mean, you were saying in this scenario, would you ever, here's one question for you, Dan. Would you ever try to hedge this position, or are you literally just putting it on and hope that ball comes out, hope that time decay and taking it off? And if you lose, you lose. I mean, what do you ever try to hedge in a scenario like this?
I don't.
As opposed to just taking the trade off.
I don't. I'm putting it on for a reason, right? Again, this is a totally like the baseball bat analogy. I'm using the baseball bat different than the intended purpose. I'm using the iron condor in a speculative purpose in a speculative trade for earnings. So when I put it on, I generally try to take it off when the event happens. So I'm trying to take it off. If I'm using the weekly, that expires in a few days, I'm generally taking it off that day. When earnings comes out, like you said, earnings came out after the close on a Wednesday, I'm taking it off Thursday morning or Thursday afternoon. Now, in this case, you have 9 days, but still, you may have to wait a little longer. But again, it's a small credit, 41, so they may hold a little bit into it. But my guess is, it's probably trading. What was it trading when this opened? Around 7 cents, maybe. I mean, it'd be hard to get out of it.
Dan, are you sure you didn't go back and look at time and tape before you came on this call?
No, I honestly didn't. I'm just just winging it here.
I know, because what basically happened was the stock the next day, and we got to wrap it up here and move on for Options Playbook Radio. But yeah, what happened the next day was that it actually moved more before their earnings report the few days before than it did on the actual earnings. So the next day it opened up 58 cents, which wasn't nothing to sneeze at, which was about 4%, which is a good move on a $15 stock, but it was nowhere close to the 25%. And according to time and tape, it was trading for 5 cents on the open the next day. And the only thing that I can say about that is if you did not get out at that moment. Oh, I'm sorry. That was actually the close price. My time and tape is showing me close price, but that was 5 cents on the close the next day. But if you did not buy that back and buy your shorts in, at least, you're just crazy on any one of these trades. As a matter of fact, you should have even been out before that. If you could have bought it back for 10 cents, I'd say you want to get out of that trade. Just trying to get that last nickel or dime out on anything that you sold is usually not worth that risk.
Hey, Brian, one quick negative, just not against you, but just for viewers that maybe are listening here. I don't normally do iron condors for earnings for this little credit. I may get more. There's nothing wrong with this. But if somebody was doing, let's say, a one contract, and the problem at some brokerage firms, if you do a one contract, they might hit you with a hefty ticket charge, right? And so if you're only bringing in $41 credit and you're doing it, let's say one time, and you have a ticket charge of $15, $20, right? That's half your profit. So I think the only negative I could see here would be for a retail trader that was only doing it 1 or 2 times, that didn't have a good commission rate, or some brokerages, when you're doing 1 or 2 contracts, they hit you with that nice hefty ticket charge. So you're not getting enough credit to offset that, in my opinion. That would be the only possible negative I could think of.
So I guess you would have to be able to do it more, or have part of your spec portfolio to have, be able to do more contracts and make it more worth your while, which that's fair. Good thing at Trade King, we don't have to worry about that as much, but so that was a nice setup for that. But in general, we're one of the lower end on the option pricing. But yeah, I understand that. If the commissions are always very important, and you got to figure them into your trades. You can't just look at a profit and loss graph and look at that. You got to add those commissions into the trades, and you also got to think about bid-ask spreads. So two things that are important. All right, Dan. Well, that's it for this episode of Options Playbook Radio. I love these discussions that we're having for the 100th episode, which is going to run into the 102nd, 103rd. I just invited a lot of friends from the options industry to basically critique the trades that we've talked about on Options Playbook Radio. And if there was one man that to talk about iron condors, not necessarily even around earnings, but just in general, I know Dan is a a big seller of iron condors in his teachings over there at Sheridan Options Mentoring. So I really do appreciate you coming in and give us your insight, Dan. Thanks for coming.
Thanks, Brian. Appreciate you having me, and thanks, Mark.
All right, everyone. Okay, that's it for this episode of Options Playbook Radio. Please let your friends know more about this program. It's free for all. We do appreciate it. Go to our Facebook page if you have any questions or suggestions, facebook.com/TradeKing. And you can send direct questions directly to me via that Facebook page. You can see archived sessions of Options Playbook Radio. And as always, you can auto-download these via iTunes or Stitcher. Thanks for coming, everyone. And we'll be back same time, same place next week with another additional episode celebrating the 100th episode of Options Playbook Radio.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.